Imagine a restaurant that's operating at the absolute peak of its physical capabilities.
Right.
You walk past the glass storefront. It's like 12:30 p.m. on a Tuesday, and the line is literally wrapping around the block.
Oh, yeah. Just a massive lunch rush.
Exactly. The kitchen staff is just moving in this synchronized blur. The digital order racks are completely overflowing with paper bags. And the register, I mean, it just does not stop ringing for a single second.
Sounds like a gold mine.
Right. And over the course of 3 months, this specific restaurant empire pulls in $3.1 billion in revenue, a totally record-breaking quarter.
That's with a B, yeah.
With a B. And yet, then the executives retreat to the back room and actually count the profit. They realized they were making 17% less money than they did a year ago.
It's wild. It completely breaks the fundamental logic of retail physics, honestly.
It really does.
Like, we are so conditioned to believe that high foot traffic and soaring top-line revenue just, automatically translate into a massive pile of profit.
Right, because why wouldn't they?
Exactly. But what we are looking at here is really a masterclass in margin illusion. It's where a company can sell more physical products to more human beings than ever before and still just watch their bottom line fall right off a cliff.
Well, welcome to the Deep Dives, everyone. Our mission today is laser focused. We're taking our talk tickers approach and applying it to, honestly, one of the most dominant players in the fast casual space. And that's Chipotle Mexican Grill, ticker symbol CMG.
It's a fascinating one right now.
It is. We are pulling apart their Q1 2026 earnings call directly for you, the retail investor. We are definitely not here to just regurgitate the corporate press release.
No, absolutely not. We're going to hit the headline numbers and then deconstruct the actual operational mechanics happening on that kitchen floor.
Right. We're parsing the forward. Guidance management is feeding Wall Street and ultimately delivering an actionable, highly opinionated bottom line on whether the stock actually belongs in your portfolio.
And the central tension of this entire quarter, the thing you have to understand, is that massive disconnect between the top line success and the bottom line reality.
Yeah, that 17% drop.
Right. They have a menu strategy that is undeniably working. I mean, they are driving traffic in a macro environment where, frankly, their competitors are just bleeding customers.
Oh, legacy fast food is struggling right now.
Big time. But Chipotle, they're operating in this macroeconomic vice grip of inflation and shifting consumer behavior that is just systematically eating the profit out of every single bowl they sell.
So let's start with section 1, the headline numbers. Let's dissect the baseline financial reality here. Because when you look at the raw revenue, the machine looks pretty unstoppable.
It really does.
I mean, first quarter revenue grew 7.4%, hitting that staggering $3.1 billion mark. And remember, this isn't some software company scaling zero marginal cost code.
Right. There's no copy paste here.
Exactly. That is an enterprise physically assembling and selling $3 billion worth of meat, rice, and beans in 90 days.
Which is an incredible logistical feat. And they achieved that volume while still managing to post a positive comparable sales number. So their comps came in at a positive 0.5% for the quarter.
Okay, I have to jump in and challenge the framing of that 0.5% number right out of the gate.
Oh, I knew you would. Go ahead.
Because look, management loves to parade literally any positive comp as a victory. But let's look at the actual math in an inflationary environment, right?
Let's do it.
If your menu prices are up nearly 1% year over year and your total same-store sales only grew 0.5%, I mean, isn't that just a red flag masquerading as a green one?
You're not wrong.
It implies that the actual physical volume of goods moving through those legacy stores might be stagnating or even shrinking, and it's masked entirely by the fact that you're just charging slightly more for the food.
Yeah, that is exactly the analytical lens you need to use here. A positive nominal comp does not always equal a healthy underlying business.
Right.
However, the nuance in this specific quarter is that their foot traffic, like the actual number of human beings walking through the door or ordering on the app, was actually up 0.6%.
Oh, wait, really? Traffic was actually up?
It was. So they aren't actually masking traffic declines with price hikes. The structural issue dragging the comps down to that flat 0.5% level is entirely related to what those customers are doing once they finally get to the register.
Which we will unpack in just a second.
Right. But from a pure demand perspective, the consumer appetite for the brand is absolutely holding steady.
Well, and their digital ecosystem is certainly doing a lot of the heavy lifting there. I saw that digital sales accounted for 38.9% of total revenue. So nearly 4 out of every 10 orders are bypassing the traditional physical assembly line entirely.
Which, if you think about it, fundamentally alters the unit economics of a restaurant.
How so?
Well, a digital order is theoretically much higher margin. You don't have a customer, pointing at the glass, deliberating over black versus pinto beans for 30 seconds.
Right, asking for a tiny bit more rice, slowing everything down.
Exactly, slowing down the throughput. The digital order just drops directly into the secondary make line in the back of the house, and the staff can build it at maximum speed.
And they are building their physical footprint to explicitly cater to that digital behavior.
Right.
Because they opened 49 new restaurants in Q1, and 42 of them included a Chipotle.
Yeah, their dedicated drive-through window for digital pickup.
Right. They literally aren't building dining rooms anymore. They're basically building fulfillment centers with a side of seating.
That's a great way to put it. But this is where that Wall Street illusion totally shatters.
Here comes the pain.
Yeah. You take the $3.1 billion in revenue, the resilient foot traffic, the digital optimization, the expanding footprint, and you run it all through the P&L.
And what comes out?
The adjusted diluted earnings per share came in at just 24 cents. That is a brutal 17% decline versus the same quarter last year.
Man, a 17% profit wipeout on a 7.4% revenue gain. The vault is getting lighter.
It really is.
And you can see the bleed so clearly in their restaurant level margins, which dropped to 23.7%. That's down 250 basis points year over year.
Right. Essentially a 2.5% drop.
Which doesn't sound like much, but for a company processing this kind of insane volume, a 2.5 percentage point contraction in restaurant level margin equates to tens of millions of dollars just evaporating before it ever reaches the corporate bottom line.
Yeah, it's a massive leak. So to understand why that money is evaporating, we have to transition to section 2, the story behind the numbers.
Let's do it.
We really need to translate these corporate talking points into the physical realities of the restaurant business.
Well, let's start with the very first excuse management offered. Right at the top of the earnings call, leadership blamed, quote, weather impacts in January.
Ah, yes, the classic weather excuse.
Right, claiming that brutal winter storms forced closures and cost them about 100 basis points in comparable sales. Now look, I understand that you can't sell a burrito if the parking lot is buried in 3 feet of snow. But literally every fast casual chain in North America deals with January weather. It is a seasonal constant. It's not a black swan event. So I have to ask you, is management just using a blizzard as a convenient smokescreen to hide a deeper structural failure in their model?
I mean, it is the oldest trick in the retail earnings playbook, blame the sky.
Right.
And while there is some mathematical truth to the claim, like they can specifically track lost operating hours across their footprint, it is essentially a distraction from the real story.
So what is the real story?
The structural narrative, the actual reason the margins are collapsing, is buried in a metric the CFO referred to as the mix drag.
Let's tear that apart for the listeners, because the CFO noted that while menu prices contributed roughly 90 basis points to the positive column, there was a mix drag of about 100 basis points, pulling it right back down.
Right. So to visualize a mixed drag, think of restaurant economics kind of like commercial aviation.
Okay, I'm tracking.
It's like an airline successfully filling every single seat on a Boeing 737. You look around, the cabin looks packed, the flight attendants are busy, the plane is at maximum capacity.
Looks like a highly profitable flight.
Exactly. But then halfway through the flight, the CFO realizes that 40% of the passengers booked their tickets using frequent flyer miles, and another 20% bought heavily discounted basic economy fares.
Ah, so the volume is there, but the revenue composition, the mix is heavily degraded.
Precisely. So applied to Chipotle, it means the customer is physically standing at the register, but the specific combination of items on their tray is fundamentally less profitable than it was a year ago.
So what are they ordering differently?
Well, the primary engine of this mix drag is the post-COVID normalization of group sizes.
Right. We aren't all locked down together anymore.
Exactly. During the pandemic, we saw a massive surge in bulk ordering. One person would order delivery for a family of 5. You had these massive average ticket sizes with multiple entrees, sides of chips, large guacamoles, big drinks.
Huge tickets.
Yeah. But as consumer behavior normalizes, and people return to, individual office lunches or just solo dining, those massive tickets are breaking apart. The transaction count stays high, but the revenue per transaction shrinks.
But it isn't just about people eating alone, right? There is also a major psychological shift happening with how the consumer views value, specifically regarding the rewards program.
Yes, the loyalty program is absolutely becoming a double-edged sword for them right now. Management explicitly cited an increase in rewards redemptions as a major component of this mix drag.
Because everyone is cashing in their points.
Right. When a highly engaged customer comes in and cashes in their accumulated points for a free chicken bowl, that counts as a transaction. It keeps the traffic numbers looking healthy.
But it brings exactly $0 of incremental revenue to that specific ticket.
Zero, while still costing the company the food, the paper, and the labor required to produce it.
Man. And they also mentioned cannibalization from their new build-your-own family meals. I thought that was super interesting.
Oh, absolutely.
So a family of 4 that might have historically ordered 4 separate, fully priced bowls, say like $45 worth of food, is now realizing they can order a bundled family meal for $35.
Right. They're gaming the system a bit.
Yeah. The company is actively giving the consumer a tool to trade down, which obviously suppresses the top-line potential of that specific demographic.
Well, it is a calculated risk, though. You offer the family meal to prevent that family from just going to the grocery store instead.
Better to get $35 than $0.
Exactly. You sacrifice the margin on the premium individual items to capture the overall visit, but when you combine the smaller group sizes, the free loyalty entrees, and the family meal trade-downs, you get that nasty 100 basis point drag on your comms.
Which really makes the traffic number they posted even more fascinating. Because despite the mixed drag, actual foot traffic was up 0.6%.
It's impressive.
It really is. In a macro environment where the lower-income consumer is aggressively pulling back on discretionary spending, driving positive traffic is incredibly difficult. And they didn't do it with heavy discounts, they did it with culinary engineering.
They did it with what they call a protein LTO strategy limited time offers.
Right.
Because the core menu at Chipotle rarely changes, which makes any new addition a massive psychological hook for their customer base.
The numbers they dropped on these menu offsets were just staggering. Let's look at the new cilantro-lime sauce. The CFO pointed out that it is outperforming their previously launched and highly successful red chimichurri sauce by a factor of 2.
Double the incidence rate.
Double.
And, the culinary economics of a sauce are just brilliant.
Oh, tell me about it.
Think about the physical composition of that product. It's chopped jalapenos, some cilantro, lime juice, and a cheap sour cream or yogurt base. The raw ingredient cost is essentially negligible.
Pennies on the dollar.
Right. It requires almost zero specialized cooking equipment, just some quick prep time in the back. But the perceived value to the consumer is massive. It completely alters the flavor profile of standard bowl. It is a high-margin hook that drives incremental visits.
But the real financial lever is the protein. They launched chicken al pastor as a limited-time offer, and they aggressively pushed double protein additions across the board. Management stated that add-on proteins reached nearly a quarter of all transactions.
That is the statistic that should make literally every restaurant operator in the country envious.
25%.
25% of the people walking in the door are looking at their standard chicken bowl and actively choosing to pay an extra $3 or $4 for a second scoop of meat.
And let's look at the unit economics of that second scoop, because it's beautiful. The labor cost to serve it is effectively zero. The employee just dips the spoon into the pan a second time.
Takes half a second.
Right. The packaging cost is zero. It goes in the same bowl. The real estate overhead is zero. The only actual cost is the raw chicken itself.
Yeah.
So that extra $3 is overwhelmingly pure profit, dropping straight to the bottom line. It is the ultimate margin enhancer.
And yet it still wasn't enough.
That's the crazy part.
Right. The cilantro lime sauce is flying off the line. A quarter of the customers are buying double meat. Traffic is positive. And they still lost 17% of their earnings per share.
It's a brutal reality check.
Which brings us to the true antagonist of the quarter. The supply chain and the labor environment.
The endless whack-a-mole game of restaurant costs. Let's break down the labor side first. Labor costs rose to 25.7% of sales, which is a 70 basis point increase year over year.
Right.
Management cited wage inflation, which sure is ubiquitous across the industry right now. But they also cited the negative leverage of lower average restaurant sales volumes during the quarter.
Now, negative leverage is a critical concept here for the listener.
Explain it for us.
A restaurant has fixed labor minimums. You need a certain number of employees to open the doors, prep the food, and run the line, regardless of whether 10 people walk in or 100 people walk in.
You're paying them either way.
Exactly. So When weather or mix drag suppresses the total dollar volume flowing through the store on a given Tuesday, the relative percentage of your revenue that gets eaten by those fixed labor costs naturally spikes. You are paying the exact same hourly wages to generate less revenue.
That makes total sense.
Yeah.
But the truly uncontrollable variable is the cost of sales, specifically food and paper. Cost of sales rose to 29.6% of revenue.
Nearly a third of every dollar.
Yeah. And the internal dynamics of that number are wild. The CFO noted that they actually modeled in massive savings this quarter because the spot prices for avocados and dairy, two of their largest historical expenses, were way down in Q1.
They caught a major break on the agricultural commodities that usually crush them. I mean, a drop in avocado prices should have been a massive tailwind for their margins.
But it wasn't, because those savings were entirely incinerated by rampant double-digit inflation in beef and freight costs.
Yeah, that's rough.
So you save millions on the guacamole, but it costs you double to put the steak on the grill, and it costs you 30% more to pay the trucking company just to deliver it to the back door.
This is the harsh reality of operating a massive physical supply chain in 2026. You are entirely at the mercy of global commodity markets. If beef prices spike, you can't just suddenly swap out your menu. You have to absorb the hit.
So the overarching equation for Q1 is a consumer who is ordering slightly less profitable combinations of food, served by employees who cost more per hour, using ingredients that are significantly more expensive to procure and ship.
That sums it up.
And that is how a $3.1 billion quarter results in a 17% profit drop.
But, and this is important, the management team isn't just acting helpless here. They aren't just shrugging their shoulders at the macroeconomic climate.
No, they're fighting back.
They are actively attempting to engineer their way out of this margin squeeze through high capex operational technology.
This was honestly the most compelling part of the entire earnings call for me. They are aggressively rolling out what they call a high-efficiency equipment package.
Which sounds very corporate, but what does it mean?
We're talking about physically retrofitting the kitchens with dual-sided planches, high-capacity fryers, and optimized 3-pan rice cookers.
To understand why this matters, you really have to understand the geometry and the choke points of a Chipotle kitchen during a peak lunch rush.
Break it down.
The bottleneck in a fast casual restaurant is almost never the point of sale. The bottleneck is the grill.
Nice.
At 12:45 p.m., when there are 50 people in the physical line and 50 more digital orders suddenly dropping into the system, the person on the make line literally cannot build a bowl if the pan of chicken is empty.
Everything stops.
Everything stops. And the traditional plancha, basically a large flat-top grill, only cooks from the bottom up. It requires a human being to constantly monitor the meat, physically flip it, and ensure it hits the right temperature. It is a slow, incredibly labor-intensive process. But a dual-sided plancha operates more like a massive panini press.
Oh, so it sears from the top and the bottom simultaneously.
Exactly.
Which cuts the cook time in half. It guarantees a perfectly consistent internal temperature without relying on the physical intuition of some busy, stressed-out line cook.
Right.
And most importantly, it means the secondary digital make line never has to pause because they're waiting on fresh steak.
And the data actually proves the thesis here. Management stated that this new equipment package is currently live in over 600 restaurants.
Okay.
In those specific locations, they are tracking a 200 to 400 basis point lift in comparable sales, purely driven by throughput.
Just by moving faster.
Just moving faster. If you can shave 10 seconds off the assembly of every single order by ensuring the pans are always full and the rice is always hot, you process more human beings per hour.
And you capture the customers who normally walk in, see a slow-moving line to the door, and just turn right back around.
The walkaways. Exactly. But they are actually taking the optimization a step further, moving beyond just thermal hardware and into algorithmic management.
You're talking about the AI.
Yes. They discussed the massive expansion of Avocado, their proprietary AI assistant.
Now, this is fascinating because in previous quarters, Avocado was really just an HR tool used to sort of streamline the hiring and onboarding process. But now they are deploying it directly into kitchen operations. Management said Ava is now providing what they call cook-to-needs guidance.
And this is a monumental shift in restaurant management. I mean, historically, how does it work? A kitchen manager looks out the window at the weather, looks at a printout of what they sold last Tuesday, and makes an educated guess about how much chicken to prep at 10:00 a.m.
Which is fraught with error.
Massively. If they guess wrong and prep too much, it's food waste, which destroys margins instantly. If they guess wrong and prep too little, they run out of food during a rush, which destroys top-line revenue.
But avocado removes the human guessing game entirely. The AI ingests real-time point-of-sale data, historical trends, local event schedules like if there's a baseball game nearby, and weather patterns, and outputs exact minute-by-minute prep instructions to the kitchen staff.
It's wild.
It tells the grill cook precisely how many pounds of steak to drop at 11:43 a.m. to perfectly meet the projected demand at 12:15 p.m. without leaving a single ounce of waste at the end of the shift.
They are essentially trying to turn a highly volatile, human-driven culinary process into a perfectly calibrated algorithmic manufacturing line.
They have to.
Yeah, because the margin for error has completely vanished in this economy.
Which perfectly sets up the pivot to Section 3. Management guidance. We've diagnosed the trauma of Q1. We see the technological tourniquets they're applying. But Wall Street is entirely forward-looking. What is leadership actually telling investors to expect for the rest of 2026?
Well, the guidance they issued is where the narrative gets truly complicated, and I think it forces investors to make a really hard decision about management's credibility.
Let's lay out the raw numbers first. They are guiding for flat comparable sales for the full year and only a positive 1% comp growth for the upcoming second quarter.
Ouch.
For a growth darling that historically conditioned the street to expect mid to high single-digit comps, this is a shockingly anemic projection. So I have to ask you, the expert here, are we looking at a classic case of corporate sandbagging?
It's the first thing everyone wonders.
Right. Is the CEO intentionally setting the bar so incredibly low that stepping over it in Q2 will look like a heroic feat of management? Or are they looking at their internal credit card data and realizing the American consumers is completely tapped out?
It's tough. The instinct is always to assume sandbagging, especially with these highly seasoned executive teams, under-promise to over-deliver.
They have page 1 of the CEO manual.
Exactly. But when you synthesize the specific guidance with the macroeconomic data coming out of the broader retail sector, I'm talking rising credit card delinquencies, exhausted savings rates. I genuinely believe this is a sober warning.
You think it's real?
I do. They are forecasting a consumer environment where growth is going to be incredibly difficult to manufacture.
Well, let's look at the specific pain they are forecasting for Q2. Because they expect that weak 1% comp growth to be met with a massive sequential step up in costs. They are actually projecting cost of sales to hit roughly 30% of total revenue.
Right, because the commodity markets are turning against them again.
Yeah.
Management warned of mid-single-digit inflation across their entire core basket. That massive break they caught on avocados in Q1, gone.
Poof.
Dairy costs rising. And beef inflation remains a persistent structural problem for them.
And labor offers literally no relief. They project labor costs to remain stubbornly anchored in the low 25% range, driven by continuous low single-digit wage inflation across their operational footprint.
So the vice is really tightening, costs are objectively going up, and traffic is projected to be essentially flat.
Now, the traditional corporate response to this exact scenario is aggressive price taking. If your costs go up 5%, you raise your menu prices 6% to protect your margin and appease the shareholders.
Right, pass the pain to the consumer.
Exactly. But this is where their strategy gets fascinating and honestly, arguably brilliant. Management announced they're taking a pricing increase in Q2
Wait for it.
of exactly 1.5%.
A 1.5% increase in a mid-single-digit inflationary environment. They are mathematically choosing not to cover their rising costs.
Why? I mean, why would a company intentionally allow its margins to compress when it clearly has a captive audience wrapping around the building?
It is a ruthless long-term market share acquisition play. The CEO explicitly stated on the call that their core mandate right now is reinforcing their value proposition.
Okay.
They pointed to internal data showing that their menu prices still remain 20 to 30% cheaper than their direct fast casual peers.
Which is crazy when you think about the quality difference. But think about the psychology of the consumer right now. If a customer is feeling the pinch, and a typical fast casual burger combo now costs $18, a $10 chicken bowl looks like an absolute sanctuary of value.
A safe haven.
Yes. If Chipotle raises that bowl to $12 or $13 just to protect their Q2 margin, they break that psychological sanctuary. The customer gets sticker shock and trades down to traditional low-tier fast food.
Exactly. By absorbing the inflation themselves, by taking the margin hit internally, they preserve the habit. They ensure the customer doesn't break their weekly routine.
It is a classic volume preservation strategy.
Yes. You sacrifice the margin today to ensure the physical foot traffic remains locked into your ecosystem when the macroeconomic weather eventually clears out.
And management really believes that clearing will happen in the back half of the year, because their full-year outlook projects cost of sales inflation to average out around 4%. They're explicitly telling investors to endure the pain of Q2 because they expect to, quote, lap the elevated beef costs in Q3 and Q4, which should theoretically create easier year-over-year margin comparisons.
But, while they wait for those commodities to cool down, they are not behaving like a company in retreat.
Not at all.
Their general and administrative guidance, their G&A, is incredibly aggressive right now. They projected $181 million in G&A spend for Q2 alone.
And you don't spend $181 million on corporate overhead if you're playing defense.
No, you don't.
Now, a massive portion of that is obviously funding the deployment of avocado and those high-efficiency kitchens we talked about. But an equally important portion is going toward elite executive talent acquisition. They announced 2 massive hires that completely telegraph their future strategy.
Oh, these hires are huge.
The first is Fernando Machado, stepping in as the new chief brand officer.
Right. And for anyone following the marketing industry over the last decade, Machado is a heavy hitter.
A legend.
He built his reputation at Burger King and Restaurant Brands International by executing highly disruptive, culturally invasive marketing campaigns. He doesn't do quiet, defensive, look at our fresh tomatoes advertising. He builds campaigns designed to completely hijack the cultural conversation.
So bringing in Machado implies that the brand feels it needs to transition from relying purely on the quality of its food to actively competing in the cultural zeitgeist.
Yeah.
They need to manufacture relevance.
Exactly. And the second hire is equally targeted. Arlie Sisson is coming on as the newly created Chief Digital Officer. Now, Sisson's background is at Hyatt, managing massive, complex, global digital ecosystems and high-tier loyalty programs.
Which makes perfect sense. You bring in a hospitality digital architect because you realize your app isn't just a digital menu board anymore. It is the primary interface for 40% of your revenue.
Right.
You need someone who knows how to optimize a loyalty program, not just to give away free food, but to extract maximum lifetime value from the user through personalized algorithmic nudging.
Yeah. These are absolutely not the hires of a company planning to shrink its footprint. These are the hires of a company preparing to aggressively widen the top of its funnel and optimize the digital conversion of literally every user who drops into it.
Which brings us to the ultimate synthesis, section 4. The bottom line. We have looked at the brutal reality of the Q1 margin collapse.
Yep.
We understand the operational warfare happening on the kitchen line with dual-sided planches and AI prep tools. We see a management team intentionally underpricing their menu to bleed their competitors while simultaneously funding aggressive executive expansion.
It's a lot of moving parts.
It is. So the question for the retail investor is, what do you actually do with all this conflating data?
Right. To frame this decision, think about the physical experience of interacting with the brand. Holding this stock right now is exactly like walking into one of their locations at 1 p.m. and seeing a line that stretches all the way to the glass door.
You just freeze.
Yeah. You're standing there, you're evaluating the situation, you know the underlying product is fundamentally strong, you know you want the outcome. But you have to decide if the immediate cost, the physical time you're going to spend waiting in that line, or in this case, the premium valuation multiple you have to pay for the stock today is actually justified by the eventual reward.
Wow, that's a great analogy.
Thanks. It requires a strict bifurcation of your investment timeline. If we look purely at the short-term horizon, let's say the next 3 to 6 months, the signal is undeniably bearish.
Undeniably. So walk us through the short-term bear case.
The math simply does not support near-term multiple expansion. The 17% EPS drop in Q1 was not a weather-induced fluke. It was a symptom of structural margin compression that management explicitly warned will accelerate in Q2. When you combine 30% cost of sales with a meager 1% comp growth projection, the upcoming Q2 earnings print is almost mathematically guaranteed to look messy. The market hates margin compression, and it will likely punish the stock in the short term as those costs flow through the P&L.
So if you're a momentum trader or, you're looking for a quick 3-month pop to fund a summer vacation, This is dead money.
Dead money.
But what if your timeline is 3 to 5 years?
Then the signal flips entirely. The long-term thesis remains incredibly robust, and the actionable advice here really depends on your current position. If you are already holding shares, you need to look past the headline EPS decline. Do not can sell based on the Q1 print.
Because the underlying foundation of the house is still solid?
Exactly. Focus on the traffic. In an economic environment where legacy fast food chains are literally seeing negative foot traffic, printing a positive 0.6% transaction gain is a massive operational victory. Their loyalty program now drives 32% of all sales, creating a very sticky, predictable revenue floor. And the international narrative is finally gaining traction. Management quietly noted that their European margins hit double digits for the first time. The global expansion thesis is actually viable now.
But what if you are on the sidelines? You're listening to this, you like the long-term story, but you haven't bought in yet.
You exercise extreme patience. Do not initiate a massive position today.
Let it play out.
Let the Q2 margin reality hit the market. Let the stock absorb the short-term volatility that comes with a 30% cost of sales quarter. Wait for the inflation comparisons to ease in the third and fourth quarters as they lap those elevated beef costs.
You're waiting for the dip.
You are looking for a dislocation, a moment when the market overreacts to the short-term margin pain, giving you an entry point before the long-term operational efficiencies really take hold.
And what is the specific operational catalyst that will signal that turning point? Like, what is the one metric investors need to track obsessively on the next call?
It all comes down to the high-efficiency equipment rollout.
The planches.
Yes. The intentional strategy of underpricing the menu to drive traffic only works if you can physically process that traffic without breaking the kitchen labor model.
Volume is the cure for margin compression, but only if the volume is efficient.
Precisely. They plan to have the dual-sided planches and optimized kitchen setups in 2,000 stores by the end of the year. If that equipment consistently delivers the 200 to 400 basis point lift in throughput they are seeing in the test stores, it fundamentally rewrites the unit economic.
Faster lines mean more transactions per hour.
Right. More transactions per hour spread the fixed labor costs over a wider revenue base, creating massive operating leverage. The equipment is literally the linchpin of the entire valuation model.
All right, so we've covered the margin illusion, the supply chain reality, the psychology of pricing, and the mechanics of the kitchen. But before we wrap this deep dive, I want to leave you with one final detail.
Ooh, what is it?
It was buried so deep in the Q&A section of the call that almost no one noticed it. But it completely changed how I view the future of this company.
Okay, what did you find?
An analyst asked a pretty mundane question about off-peak traffic, and the CEO casually mentioned that they're preparing to test a concept in select markets called happier hour.
Happier hour.
Yeah. From $2 p.m. to $5 p.m., which is the notorious dead zone in the restaurant industry, they're going to offer $2.50 tacos. The stated goal is to, quote, test their pricing elasticity.
Well, I mean, that sounds like a very standard localized promotional lever. You lower the price to drive traffic when the dining room is empty.
If you look at it in isolation, yes. But we don't look at things in isolation on this show. I want you to combine the concept of happier hour with the technology we just spent 20 minutes discussing, Avocado.
Oh, the AI prep system.
Exactly. Think about it. You have an AI system plugged directly into the physical make line, monitoring exactly how much food is prepped, predicting exactly how much traffic is going to arrive based on real-time weather and event data. And now you have a management team openly testing time-based dynamic pricing discounts to gauge consumer elasticity.
Wait, you are suggesting they aren't just trying to sell cheap tacos in the afternoon. They are building the infrastructure for algorithmic dynamic pricing.
Think about the mechanics of Uber surge pricing applied to physical food. Are we looking at a near future where the digital menu board changes prices minute by minute based on the AI's assessment of inventory and demand?
That is wow.
Imagine walking in at 12:15 p.m. during a rush, and a chicken bowl is $11. But you open the app, and it tells you that if you wait until 2:40 p.m., the AI will drop the price to $8.50, specifically to clear out the remaining lunch prep before the dinner shift begins.
That would completely eliminate food waste. It perfectly optimizes labor utilization, and it allows them to extract the maximum possible margin from the price-insensitive lunch crowd while still capturing the highly price-sensitive afternoon consumer. It is a radical reimagining of restaurant economics.
And they are quietly installing the exact hardware, software, and executive talent required to execute it. Technology isn't just going to change how they cook the food, it is going to fundamentally dictate how the food is valued in real time. It's something to seriously think about the next time you are standing in that line. When you are evaluating these massive corporate machines, you really have to look past the top-line revenue, dig into the margins, and pay attention to the algorithmic future they are building in the back room. Thank you for joining us on this deep dive. Keep your portfolios diverse, keep your minds open, and we will catch you next time.